numbers that they gave this time around. The stock, that'll come up for you on the screen and we'll just see how that's performing right now. But overall, if we look at the numbers, it was a slower revenue growth, margins had contracted, profits were led higher by other income and lower finance costs as well. So overall, revenues were up around 11%, EBITDA was down 8.5%, margins contracted to 6.7% versus 8.2%, and it was a profit versus a loss last year. So that is the first corporate on our radar. Let's get in the quarter gone by and the outlook for FY25. We have Mr. Ravi Viswanathan, the Managing Director, and Mr. Raviprakash, Global CFO of the company, joining in now. Gentlemen, good morning. Thank you so much for joining in today. Well, you know, it has been on the weakish side if we talk about the margins this time around. Can you explain what went wrong with the margins and what is the outlook on overall growth on revenues, profits and margins for FY25?
Yeah, thank you. And, we've shown a very healthy growth in revenue, about 11% year on year, and we continue on our growth momentum. Margins have declined a bit, but if you look at it from an integrated supply chain solutions, that has been our growth engine, and that's something which we've been talking to you in the past, and that has grown very significantly, and we have 11% EBITDA on the ISCS segment. The network solution segment has been a bit volatile, and we're very proud of the fact that we're growing revenues in spite of weak macros. But I would say that network solution segment is still work in progress. The good news is that one of the segments there, the integrated final mile, we had reported some challenges earlier, and we have put that behind us, and we expect to have run rate profitability coming in from the end of this fiscal year, that is Q4 FY25. So overall, outlook is very positive. Revenue momentum is great. We are winning significantly large deals. We've spoken about it in the past. We had won a very large deal with a UK customer earlier last year, and we've reported a similar or a larger contract signing in the last quarter with a North American customer. So we are very positive and bullish about the outlook as we look at the half-year performance of the company.
Gentlemen, hi, Reema here. Ravi, just explain the decline in margins seen on network solutions. I understand it's work in progress, but are there any factors which led to the margin decline? And since one of the segments of this will turn profitable or the outlook is improving, do you have any exit margins in mind for the network solutions business?
Yes. So, Reema, in the network segment, there are three factors which actually impacted this quarter. Because of the impact of the Red Sea, what is happening is the ships in the freight forwarding side of the business, we are having to incur significant costs for a number of our customers, which is actually simply an add-on to revenue with no incremental margin. The impact of that is almost, in revenue terms, almost 80 crores. That is actually depressing the margin because it's kind of revenue without any margin. The second part is, like Ravi Viswanathan talked about, our business, the last mile business, integrated final mile business. We had signaled that it was a work in progress in terms of profitability. The progress is good, and we expect that the coming quarters, the numbers will improve. And therefore, if I look at Q3 and Q4, we would be comfortable if we were to exit Q3 at closer to the margins that existed maybe a couple of quarters ago, and then probably trend towards our target margins of about 7% over the next 3 to 4 quarters.
Okay, 7% margins over the next 3 to 4 quarters. This is for the network solutions business.
Yes.
Okay. You spoke about a large industrial customer you had in North America. You've been winning new contracts as well. And there is one 7-year strategic contract with a UK governmental agency. Can you give us a sense of what is the order pipeline looking like in terms of these contracts? What is the execution timeline as well? And what would the expected margins in the newer contracts be? Mr. Viswanathan, if you can take this.
Sure. Yes, we have signed probably the largest contract in the history of the company. It's over 22 plus crores as the total contract value. It's a multi-year engagement with an industrial segment customer. Hopefully, we'll be able to get to a place where we can share the name of the customer as we progress, but we still are under very strict confidentiality. But having said that, we continue to look at large deals as a vehicle of growth. We have significant number of large deals that we are participating in. the number of large deals that we participated in 3 years ago versus now in the US has gone up by about 2.5 times and about 3.5 times in the UK. So it clearly positions us as a large contract player, which we were not 3 years ago. And it augurs very well for our growth. From a profitability perspective, like Raviprakash mentioned, we look at growing our margins. Our EBITDA numbers, we had indicated at a company level, we want to grow it to double-digit EBITDA, and that's going to come on the back of these large contracts. So we expect the larger contracts to be at a differential to the current EBITDA margin that the ISCS segment has, and ISCS already is performing at a double-digit EBITDA number. This quarter, our EBITDA margin was about 11%. So this large deal is in the ISCS segment, and we expect the margins to be better than what our average margins.
Yes, how much better would those margins be? 200 basis points, 300 basis points, any number there?
Maybe, I think let's not maybe put a number on that. Definitely better than what we are having in our average margins for the ISCS segment. On a lighter note, let the contract start and we start delivering numbers and let the numbers come through the results.
So Ravi, this aspiration of double-digit margins, when will you be able to achieve it? And you also had given a guidance of 4% PBT margins and 16.5% ROCE by FY27. So this double-digit margins is by FY27, I presume?
Yes, I think that goal still stays. Look, the ISCS segment has already hit double-digit EBITDA margin. Network segment, I already reiterated our target is to get to around 7% at a start. And then once we do that, and if we continue the revenue growth like we have right now, and we are holding a very tight rein on our overhead, operating leverage will come through. And we do want to stick to the 4% PBT margin by 27. So that sticks.
All right. Okay. Thank you, Mr. Raviprakash and Mr. Viswanathan, for joining in today and giving us the details of the quarter gone by and, most importantly, the outlook going forward. That's the word coming in from TVS Supply Chain Solutions. The stock is up by 3% on the back of the numbers and management commentary. Time for a short break now. On the